There are a lot of misconceptions when it comes to investing in the stock market. Investing is the same as trading or gambling, or it is a get-rich-quick scheme, to name a few. Not only are these misleading, but they also lead people away from the most effective way of growing your money. Investing in a nutshell is a proven way to build wealth over a long period of time. There's data that goes back decades that proves this. Consider this for example. If you had invested $8,000 in the S&P 500 index in 1980, your investment would be nominally worth approximately $783,086.76 in 2021. So let's break it down. There are two ways you can make money in the stock market: capital appreciation and dividends. In simpler terms, the first way to make money is where you sell stock shares more than you bought them for. For example, if you bought an Apple stock at $50 a share and sell the share when the price hits $120 a share, you pocket the difference. The second way to make money is through dividends. A dividend is a cash payout by the company to its shareholders. A portion of the company's earnings is distributed to shareholders in the form of dividends as a token of appreciation for investing in the company. The payouts are made at frequent intervals, usually annually or quarterly, although there are some stocks that pay a monthly dividend. So you invest in dividend stocks and get paid frequently. Dividends are a great way to generate passive income, as there's virtually no effort involved in earning dividends. Hence, investors often look for stocks that pay dividends in order to generate returns on top of the capital gains from the stock. This strategy is referred to as dividend investing. Now let's dive deeper into it. What is dividend investing? As we said, investors buy dividend-paying stocks to increase their profit, generate passive income, or compound their returns over time. Investing in dividend-paying stocks allows investors to generate cash from their stocks at virtually no extra cost or effort. Also, dividend stocks act as a hedge against market volatility. The reason is, whether it's a bull or bear market, dividend-paying stocks will ensure returns for your portfolio, especially in a bear market when you see your investments lose value. It's good to have a consistent income that can alleviate the impact. However, bear in mind that not all stocks pay a dividend. Instead of paying shareholders, the company might reinvest earnings into R&D, expansion, or acquiring businesses, and that can drive up the price, which ultimately benefits the shareholders. Now, you know what dividend stock investing is. Let's take a look at how you can find the best dividend stocks for your investment portfolio. When it comes to selecting stocks that pay dividends, these are some metrics to look at. Dividend yield. Dividend yields are the first metric investors look at when addressing potential dividend stocks. It is the annualized dividend, expressed as a percentage of the stock price. So if a company pays a total dividend of $5 a share and the share price is $100, the dividend yield is 5%. The higher the dividend yield, the more you get in dividends. But there's a catch here. High dividend yields are not always ideal, because you see, when calculating the dividend yield, the dividend that was paid in the previous year is taken into consideration. So a decline in stock price will result in a higher dividend yield. Novice investors might see this as a great dividend-paying stock when actually it isn't. So investors should ideally look at more metrics to get a clearer picture of the company. Payout ratio. The dividend payout ratio, or simply payout ratio, is a measure of how much a company's earnings are distributed to shareholders as dividends in a year. It is calculated by dividend paid divided by net income and expressed in percentage. For instance, if Apple pays 24% of its net income in dividends, then Apple's payout ratio is 24%. It can also be calculated by dividing dividend per share by earnings per share. As for an ideal ratio, consider investing in companies that pay not more than 55% of their net income. This makes sure that you can keep paying dividends consistently without having to compromise reinvestments in the business. Now that you know what to look for in a dividend stock, let's discuss how to create a passive income from these stocks. One of the best ways to do this is to create a dividend portfolio. A dividend portfolio is a collection of dividend stocks that are held for the purpose of generating passive income. When constructing a dividend portfolio, you want to diversify your holdings across different sectors and industries. This will help reduce the overall risk of your investment and ensure that you're getting a steady stream of passive income.